Hello everybody, my name is Hoby This is Project 1 for Finance 695. Today I'm going to talk to you about an investment strategy of my choice, and I'm going to test that to see if it actually works. The strategy I chose is to invest in high ROE stocks. The reason why I chose this is because it's one of Warren Buffett's main factors when he's looking at companies that he wants to invest in. My hypothesis was that high ROE stocks will have a high statistical significance to the 52-week percentage change in stock price, and low ROE stocks will not. Return on equity, this gives you the amount of profit for every dollar in shareholder equity. It is a measure of how stockholders did during the year, and is one of the most important accounting indications of management success in accomplishing the shareholders' valuation objective, which that should be to maximize shareholder wealth. ROE can be described in several ways. It can be the net income divided by total equity. It also can be described as ROA multiplied by the equity multiplier. That can be further broken down into the profit margin times total asset turnover times the equity multiplier. Even further broken down further, you can take profit margin into interest burden, tax burden, EBIT margin, then once again times the total asset turnover and equity multiplier. So point being, return on equity includes a lot of different factors in the company's financial status. Return on equity continued. Basically, a higher ROE means that surplus funds can be invested to improve business operations without the stockholders having to put in more money. Also, it takes into account the retained earnings from previous years, and it tells investors how effectively the capital is being reinvested. So this is why it serves as a better gauge of management's adaptiveness than the annual earnings per share, which is also can be a good indicator of the financial strength of a company, but I chose to go with ROE primarily because it's one of the things that Warren Buffett promotes a lot. My method, I chose from Yahoo Finance. I did retrieve the most recent ROE figure and the most 52-week percentage change in stock price figures for the Dow 30. I chose the Dow 30 because it's a very broad mix of different companies, different industries. It can range from Caterpillar to Home Depot, IBM, AT&T, a bunch of different companies. This is a list of the Dow 30. What I did is, as I said, I took the ROE, I sorted it from high to low, and initially what I did is I just did a straight split half and half, the top 15 and the bottom 15, and I wanted to see if that had any correlation to the 52-week percentage change in stock price. So I took this data, I entered it into Excel, I did a regression analysis on the following groups. I did the top 15 and the bottom 15, and I looked for a p-value less than 0.01 and a t-stat with an absolute value of above 1.65 to test it for statistical significance. So this means I was looking for a 99% confidence interval. My findings, I initially found that ROE was not statistically significant to the 52-week percentage change in stock price for the bottom 15, but I expected to find that. What I didn't expect to find is that the top 15 also had no correlation to the 52-week percentage change in stock price. You can see here, this is the bottom 15, t-stat 0.75, p-value 0.466. For the bottom 15, t-stat negative 1.23, so it's a little bit closer. Also, p-value is a little bit closer, but still not enough to determine statistical significance. So once I found this, then I figured, well, let me go back and let me look at some other different groups of the Dow 30. So what I did was I went back and I broke that down further into the top 10, middle 10, bottom 10, and then all 30 as a group, just to see if I can find any patterns within these groups. Come to find out, I found there's no high correlation in any of these groups. The closest was the top 10 right here. It had a t-stat of 1.45 and a p-value of 0.18. Compared to the others, all the others were much further than that. but I still found that to be somewhat interesting, but unfortunately it's not enough to have hard data to go by and say that it truly is significant. In conclusion, my regression analysis found there was no significant correlation between the ROE and 52-week percentage change in stock price, no matter how I broke it down, basically. This could have been due to only using the most recent ROE figure and the most recent 52-week percentage change in stock price. I could, looking back, I could have gone and looked at maybe the past 3 years, past 5, past 10 years, and taken an average of that. But hindsight's always 20/20. Debt financing, that could, which is the increase in long-term debt-to-equity ratio, that could be another factor that is causing some skewness in my data, because that can be misleading since it can increase your return on equity. That could become problematic if those interest rates rise or fall, because leverage magnifies gains, magnifies losses, so that could have very well been a factor as well. And that is my investment strategy. Thank you.